Welcome one, welcome all to DeFi Crypto and Airdrops, DeFi High, brought to you by DeFi University. And David, how's it going, brother?
Oh man, it's going great, Mike. And just before the call today, I was able to get the crypto fundamentals course published over on the DeFi University course hub, and I think I'm sharing it now. But yeah, man, whenever you're ready to hop in, I'm ready to get started because
Let's do this thing.
we've got a couple of lessons to get through, and this is, I think, the perfect follow-up to the money basics content. So there were a couple of themes in this money basics content that we start off with here in the crypto fundamentals course. Number one, no middleman required. How cool is that? So we're going to go through lesson 1, lesson 2, and lesson 3. So lesson 1 is no middleman required. And we can just run through this real quick. We're going to watch that video content and then run through the written content. And then lesson 2 is true ownership explained. And so we're going to talk about custody. And we can run through that lesson content here just real quick. And then lesson 3 is global and permissionless. So permissionless finance. Remember, these are all the concepts that we started learning about in the money basics course. So if you haven't had a chance to go through the money basics course, give that a shot first. Then hop on over here to crypto fundamentals. Let's take a look, Mike. Let's run through the digital vending machine. No middleman required.
All right, let's jump right in. We're going to unpack.
There's like a really bad echo.
Yep, it's because it's playing from, there we go, headphones. Awesome.
One of the biggest, most fundamental ideas. All right, let's jump right in. We're going to unpack one of the biggest, most fundamental ideas in all of cryptocurrency. And the best part? We're going to do it using a super simple analogy that, well, you probably see almost every day. So let's start with a question. Just imagine for a second, what if sending money to anyone, anywhere on the planet, was as simple and direct as buying a soda from a vending machine? Just hold on to that thought, because it's literally the key to understanding everything else we're about to cover. Okay, so to really get this concept, we're going to compare two totally different ways of doing things, starting with our digital vending machine idea. Think about it like this. On one side, you've got the bank teller. That's a process, right? It's full of forms you have to fill out, IDs you have to show, and then you have to wait for a person to actually approve it. But on the other side, you've got the vending machine. You put your money in, you press a button, and you get what you want instantly.
So the vending machine, and we're going to get to this later on in the course material, not today, but in one of the future courses. This vending machine here, what you're actually doing is you're depositing tokens into a liquidity pool and then withdrawing tokens from a liquidity pool using an AMM. So in DeFi, this vending machine uses an automated market maker. Whereas in TradFi, when you go to a bank, or go online to your bank, you've got to potentially ask permission of an individual, of a person. That is not the case over here in DeFi.
No permission needed, even if it's 3 a.m. This simple contrast, it's at the heart of this entire conversation. So that bank teller model we just talked about, that's basically a perfect stand-in for our traditional financial system. And why is that? Because it is a world that is absolutely full of middlemen. So where does all that friction and waiting come from? Well, every single one of these steps introduces a chance for a delay. And each step requires a human being somewhere to give it the thumbs up. The whole system is built around security, which is good, but that security makes it really slow and honestly kind of clunky. Now, let's be totally fair here.
So,
It's
Mike,
crucial
let's take a look at all those steps. So if you go to the bank teller, you've got to walk to the counter. So you've got to physically get there in person. But you've also got to get there in person during banking hours, which, is like they're only open for like 37 minutes every other Wednesday, so you got to get there when they're open. And then you got to potentially fill out a form and you got to show your ID, and then you've got to wait for the bank teller to look at the ID and look up at you a couple of times, just make sure. And then you get approval, potentially. You got to get their approval to actually perform the transaction, and then you receive the item.
And keep in mind that you also and in the chat yesterday, I think it was Hoofty or somebody was talking about how, you know, they went in for $2,000 and they had to make an appointment so that they could make sure that they had the money on hand. It's like, you don't have $2,000 in cash on hand? Like, I thought you were a bank.
That's so crazy to me, man. I've seen ATMs limit withdrawals to $200, regardless of how much you have in your account. So you got to ask yourself, with the traditional banks, like, do you actually own anything? I don't think you do.
No.
I think you'll own nothing, eat bugs, and be happy. That's what they want.
Yeah.
Makes it really slow and honestly kind of clunky. Now, let's be totally fair here. It's crucial to understand that these middlemen aren't just there for no reason. They actually provide some incredibly valuable services. You know, if your credit card gets stolen, they're the ones who help with the fraud protection. If you forget your password, they help you get back into your account. They create this safety net that, let's be honest, we've all come to depend on.
And, this is a big difference between TradFi and crypto DeFi. In crypto and DeFi, you don't really have any of this. Like, not really. I mean, maybe like if you're using a ledger product, you might have some type of account recovery, but then you got to trust a ledger with your keys. Dispute resolution, I mean, not really. Insurance on deposits, sometimes there are insurance products in DeFi. Fraud protection, nope, you're on your own.
Yeah.
So, I guess for many people, there probably still is value in having some of these items, but you pay for it. It's not free. These middlemen, they charge at every turn. So yeah, I just want to always be making that, comparison between crypto and DeFi and the TradFi products.
But that safety net, it definitely comes at a cost. There are fees, both the ones you see and the ones you don't. There are delays, like waiting 3 days for a bank transfer to clear. There are restrictions on who can even join the system in the first place. And maybe the biggest one of all is control. At the end of the day, they can freeze your funds if they decide to.
So in crypto DeFi, we have control over our own assets because we own them. We custody them. Are there restrictions on what we can buy or where we can send money or who we can send money to? No, there are not. Are there delays? I wouldn't say so. I think that the biggest, what do you think?
Potentially. I mean, there is instances that, where like when I told you about my plasma experience where I was trying to exit a liquidity pool and I was having issues. It was probably user error, but still there's technical issues that you have to learn and work through and, to be able to get, those transactions to go through to remove that liquidity from a liquidity pool, or if you're trying to get into a liquidity pool and it's just not working properly, there's, it's not super common, but there can be issues.
I think you're right. Yeah, there definitely can be delays. I mean, look, I've experienced stuff like that, when there are smart contract errors and you're waiting for the team building the dApp to fix it. Well, that's a delay.
Or if the network is busy. If
Yeah.
Ethereum's network is super busy, it's either going to be super expensive or sometimes, it fails. So you have to keep trying. So
that actually happened to me the other day, man. Oh, it's so frustrating.
Yeah, it is.
Yeah, and the fees. So the delays and fees, when there are really big periods of volatility, like what we're experiencing now, on Ethereum, and not so much on its layer twos, but definitely on the main net. Like a couple nights ago, when the crash really started, I think it was Saturday or Sunday.
Yeah, I think it was early Saturday.
Yeah, it must have been Saturday. I was trying to execute a transaction, and I was doing that on ETH mainnet. And gas was $15 for this transaction, which was actually quite a lot. And the transaction failed 3 times. So, $15, $30, $45 in gas. I think it ended up being almost a little bit more than that. And the transaction never completed. So it just failed several times over. And, I just figured, hey, you know what? I'm going to have to wait until tomorrow. So yeah, that can happen. And that's, when it comes to fees though, I think mainly you're going to be paying gas, right?
Yeah. Yeah, I mean, for the most part, yeah. I mean, there's very small fees for swaps and things like that, but and then if you opt in, like to automations on VFAT or something like that, there's small fees for that, but they're add-ons, they're optional.
Right, right. So it's basically going to be, gas and slippage, and also, fees when you're on ramping or off ramping, like going from fiat to crypto and vice versa. So fees, basically like small transaction fees to get your fiat onto digital rails and to get your fiat off of digital rails. Usually there's some type of a fee if you send a wire or something like that. You're going to pay gas for every transaction, but if you're on a layer 2 or if you're on Solana or Sui, you're basically paying zero in gas. The gas is almost negligible. And so at that point, it's really just transaction fees when you operate. And there you just have to be careful of slippage. So the fees are much, much smaller, much more manageable. The delays, you really, it comes down to, I guess, volatility and the app that you're using, whether you're going to experience delays or not. Restrictions, basically none. You just have to, there are certain apps that will restrict you based on geolocation. So you might have to use a VPN. But as far as control goes, like you have full control. But with full control comes full responsibility, right? Yeah.
And and a little bit of risk, but and one thing I'd like to I want to keep pointing out is for as far as on ramping fiat, the best way that I've found is using Coinbase, buying USDC because it doesn't cost anything, and you can send it from Coinbase to your wallet for free. It doesn't cost anything, so that's the
Yeah.
best. That's the best way I've found so far to onboard fiat into crypto.
So, my favorite way to on ramp and not necessarily to off ramp, only if I have to off ramp directly to a bank account will I use this, but I really prefer Spritz.
Never heard of
Spritz.finance. Oh yeah, it's so good, man.
it. Okay.
SPRITZ, I think, with a Z. I think it's with a Z. Let me just double check that real quick so I don't give everyone the wrong URL. So SPRITZ, yep, Spritz.finance. So this is my favorite on off ramp. They've got a couple of products also, in addition to that. But this is by far my favorite. So definitely worth taking a look at. But why don't we bring it back on over here? The costs of
Your
middlemen.
funds if they decide to. So, what's the alternative? This brings us right back to that vending machine. This is the path that cryptocurrency proposes, a direct, person-to-person or peer-to-peer system. And wow, what a difference, right? The process is totally automated because the rules are just baked right into the code of the system itself. If you meet the simple requirements, like you have the funds and you've got the right address, the transaction just happens. No human approval necessary. And this is what peer-to-peer really means here. It's all about recreating the simple act of handing someone cash, but doing it digitally on a global scale. There's no companies sitting in between you and the other person with the power to say no or take an extra cut. I mean, just look at this. This is what a traditional money transfer actually looks like behind the scenes. It is not a straight line. Your money zigzags through all these different institutions. First your bank, then a payment network like Swift, then their bank, before it finally gets where it's going. Every single one of those arrows is a middleman. Now, by contrast, a crypto transfer is, well, it's a straight line, from you to them. The network of computers around the world confirms it all, but there's no single company sitting in the middle slowing it down or taking a piece of the action. It's a fundamental rewiring of how money moves. Okay, so it's a different system. We get it, it's more direct. But why does this actually matter in the real world? Like, who really benefits from all this? Well, for one, it's about the cost. Sending money internationally, that's called remittances, can have average fees of nearly 7%. Think about that.
What?
For someone sending a couple $100s home to their family, that's a huge slice. With
So, Mike, I had no idea. Remittances, the average fee is 7%.
Yeah, Western Union and stuff like that. Before crypto, a lot of people that, from different countries like, Mexico, India, places like that, Africa, that would go to other countries and work and try to send money home. They used to get bent over, like to the tune of, 7% or more. And, as soon as they figured out crypto, it was a game changer because again, you could just peer to peer, no fees, no anything. So yeah, I mean, I don't think people realize that, the great equalizer that crypto is. And, again, I was talking about this on the Mario Nafal show yesterday with Starlink. People around the globe now have connectivity. So with crypto and that connectivity, honestly, we don't really need banks for most things.
I agree with you. I agree. I just had no idea that it was 7%. I mean,
Yeah.
even for crypto, it basically, this chart looks like it's 1% for crypto, but not even 1%. Like if you have USDC in your wallet on a layer 2 chain or Solana or Sui, and your family member who's receiving that digital asset, has an account on any of those chains,
Yeah.
you can basically send that USDC for next to zero.
Well,
So
and again, Coinbase, you can do it for free.
right. I'm thinking, decentralized.
Decentralized, yes.
Right. So I mean, of course, you could do that on Coinbase, but on from your DeFi wallet on your phone for those who are unbanked, right? Like if you're unbanked, you probably don't have a Coinbase account, right? But you can definitely have a cell phone, and on that cell phone, you can have your Rabby wallet or your Phantom wallet, or pick your wallet, any of them, and you can receive crypto basically for free. Well, I mean, when you receive it, it's free. You don't pay anything to receive, but you can send it basically for free too. So, it completely eliminates this entire business model here. Like, why would anyone ever pay 7% to send money home when they could just, call up grandma and say, hey, grandma, download this Phantom wallet on your phone and I'll be able to send you USDC. And then you can spend it like cash. I mean, it completely removes.
That might be a long phone call with some grandparents.
Right.
Download, what's that?
What's the Phantom?
Where do I go to do?
Oh man.
Crypto, those fees can drop way down, often below 1%. That's real money that stays in people's pockets.
And then there's the issue of access. Look at this number, 1.4 billion. That's how many adults around the world don't have a bank account. For them, our bank teller isn't even an option. But a peer-to-peer system that you can access with just a basic smartphone, that could open up the global economy to people who have been completely locked out. And for people living in countries with unstable governments or banks you can't really rely on, having a way to save and send money that doesn't depend on those local institutions, well, that can be an absolute lifeline. It's about having control over your own finances when you can't trust the middlemen. And listen, this is probably the most important part of this entire explainer. This is not some perfect magic solution. It's a deliberate choice. It is a trade-off. So by getting rid of the middlemen, you gain some pretty huge advantages. Transactions can happen in minutes, not days. The fees are often way lower, and access is open to basically anyone with an internet connection. And most importantly, you have total sovereign control over your funds. But here's the other side of that coin. Here is what you lose. That safety net. There's no fraud department to call if you get scammed. There's no forgot my password button if you lose your private keys. And there's absolutely no way to reverse a mistaken transaction. You're giving up the simplicity of having someone else manage all that security for you.
So, this stuff, Myke, when I first got started in crypto full time, this stuff kind of, it wasn't so much the fraud protection or any of these individually. It was just there's so much to learn. And when you first start sending transactions to addresses, for me at least, I was reading every single digit on the address to make sure that I got it right.
Started doing the first 5 and the last 5.
Yes, basically. So, just making sure that I did everything right on the right chain with the right address, with the right asset.
Doing a test transaction,
all of it. Yes. Test transactions. And, that was, I would be sweating a little bit when I would send a big transfer, or, whenever I had to initiate a bridge, it would make me a little bit uneasy. So all of those things, I think that goes away with experience and education. And, but this stuff here, like, there is no fraud protection team in DeFi. It doesn't exist.
Yeah.
There's no account recovery in DeFi. There's no dispute resolution in DeFi. But once you learn how to use it, the simplicity of operating in DeFi, at least, that's the way that I view it now. It's so much better than anything, any TradFi product.
Well, and all this can change, I mean, with with the stuff that's being built out, I mean, it's, as this evolves and DeFi gets integrated, into TradFi and just becomes, kind of part of the financial system, it's like, yeah, there's going to be a trade-off. There's going to be centralization and, things like that. And there might be fees if you want to add fraud protection or, account recovery, or, if it's on a network that allows clawbacks where, you mistakenly sent something and, you want it to come back. But again, that all comes at a cost. You're giving up, a lot of that, decentralization, a lot of that freedom, because if, your transaction can get clawed back, somebody that, sends you, crypto or something like that, or liquidity, can claw that back, or the government can claw it back, or, there's, there's a balance that you need to find.
Yeah, no kidding. But I prefer not having the middlemen.
This really gets to the very heart of it. This new technology isn't a free lunch. It offers you so much more control, but it demands so much more responsibility in return.
Right.
In this system, you are your own bank, for better and for worse. And that brings us right back to where we started. On one side, you've got the vending machine, offering you speed, access, and control. On the other, the bank teller, offering safety, support, and that safety net. Now that you understand this fundamental trade-off, the real question isn't about which one is better. The real question is for you to decide, when is that direct control worth the extra responsibility?
Well, I think that it's worth the extra responsibility if you can't afford to pay all of the fees that are associated with these TradFi products. So if you're remitting money back to your family in a different country, you probably can't afford to pay 7% on that transaction or more. So I think having control for a transaction like that, I think that's a no-brainer. There,
Well,
yeah,
or if you live in a place that, isn't, or if you're worried about, theft, if you're worried about somebody, robbing you for some reason, you're traveling through, a sketchy area, a sketchy country, you're, doing Doctors Without Borders or something like that, and, Africa, and, some sketchy place, and you don't want to be carrying cash and, that kind of thing on you, then, DeFi, it's like they can take your phone, they can take your laptop, but that doesn't necessarily give them access to, your value, your liquidity. So it's, again, it's all a balance of, kind of, risk to, what you're trying to accomplish.
yeah, I prefer just operating in this peer-to-peer system where you don't have all of these intermediaries here. So, like, you take a look at a traditional transfer. There's you, right? And then there's your bank. They take a cut. There's the payment network. They need a taste. Then there's the recipient's bank, and then there's your recipient. So, all of these intermediaries here, they're all going to want to, either take a direct fee or earn some type of yield off of your transfer. And it can take forever, and any of them can say no at some point. So, that is the traditional transfer. But in crypto, peer-to-peer, it's you send money to them. Done. Simple. So
Mhm.
I much prefer this system, but it comes with a level of responsibility that you have to be willing to accept, because there is no fraud protection. There is no account recovery. There is no dispute resolution. And yes, kind of, sort of, there can be insurance on deposits sometimes, but not really. So you got to just, be willing to accept that you will, when you custody your own assets, that's real self-sovereignty, and that requires self-responsibility. So let's take a look here at lesson 2, true ownership explained.
In crypto, there's this one concept that trips up pretty much everyone when they first start out. It's the critical difference between someone promising you your money and you actually possessing it. So let's break down why this one simple idea is maybe the most important thing you need to get your head around. Okay, so picture this. You've gone onto an exchange, maybe Coinbase or Kraken, you hit that buy button, and boom, you see a balance in your account. The natural assumption is that you own that crypto. You'd think so, right?
What do you think, Mike? Do you own that crypto?
No.
Nope.
But the answer is actually a little more complicated than you might think, and honestly, it might just surprise you. And that brings us to a pretty provocative, kind of mind-blowing idea, really. When your
Provocative.
crypto is sitting on an exchange, it isn't actually yours. Yep, you heard that right. That balance you're looking at in your account, that's not the asset itself. It's really just an IOU. It's the exchange's promise to give you the crypto whenever you ask for it. You're basically just trusting them. You're trusting them to make good on that promise.
Okay, to make this whole thing really click, let's use an analogy from the good old traditional world. It perfectly explains this idea of a promise versus actual possession.
All right, we're going to look at two different scenarios. In the first one, you've got physical cash right there in your hand. In the second, your money is stored away in a bank's vault. On the surface, they might seem pretty similar, but let's dig in and see just how different they really are.
Okay, scenario A, cash in your pocket. Here you have absolute control. It's yours, full stop. You can spend it, you can hide it, you can give it away, and here's the key part. No one can stop you. That is what direct possession feels like.
Now, let's flip that and look at scenario B. When your money is in the bank, you have access most of the time. But come on, we've all been there, right? The ATM is down. The bank's closed for some random holiday. There are withdrawal limits, or even worse, your account gets flagged for some reason, where they just close it. See the difference? You are completely dependent on the bank.
Right.
And this right here is the whole point of self-custody in crypto. It's designed to work exactly like scenario A. Think of it as digital cash in your pocket. You hold the real asset, not just someone's promise to give you the asset.
Right. And so when you custody your own assets, that means you can spend them in any way that you choose. Here's the problem, though. If your counterparty doesn't accept them, then you can't spend them. So like if you go to Starbucks or you go to, I'm just using the coffee shop as an example, and they don't accept Bitcoin or Ethereum or USDC or USDT, then
You're
it
going to have
doesn't
to
matter.
swap it to something that they do accept.
Right. It doesn't matter what you got in your phone. If they don't accept it, you can't transact. So, this is true self-custody, but the counterparty has to accept it.
Oh, I mean, it's the same thing with fiat. You can have, Canadian money and, be in the US, and most places, unless they're close to the border, probably aren't going to accept it. I mean, it still technically has value. It's just not accepted.
Yeah. I'm thinking also about the actual rails, the payment rails. Like if I've got USDC in my wallet, I think of that as cash. But if I'm walking into like an in real life establishment and I want to buy something, well, if I've got USDC and they don't accept USDC because they don't have the payment rail set up, then that USDC is no good to me. So I need a way to go from USDC on digital rails to, plain old cash. And there are plenty of ways to do that. We call them off ramps. But yeah, man, that can be one of the choke points. I think that's probably why the DOJ named that Operation Choke Point, because if you can restrict the ability to get on or off of digital rails, it kind of chokes the digital rails. And I think that was their goal under the Biden regime. But, here, like, as long as you can transact with your USDC in person, then it becomes cash, I think. But if you can't, then it's just kind of cash on digital rails. So,
okay, what actually happens when you trust a third party, what we call a custodian, with your assets? Well, it introduces a whole new set of risks you might not have even thought about.
Yeah, the official term for this is custodial. It sounds fancy, but all it means is that someone else is holding your stuff for you. We're totally used to this, right? Banks do it, stockbrokers do it, and in the crypto world, the exchanges are the custodians. And here's the trap. This is the big one. When you leave your funds on an exchange, you're not just taking on the risk of the crypto itself. You are exposed to all of their business risks. I mean, what if the exchange gets hacked? What if it goes bankrupt? What if some person at the exchange decides to just freeze your account, or a government regulator shuts the whole thing down? Just like that, your access to what you thought was your money could be gone.
This all leads to maybe the most famous saying in the entire crypto world: not your keys, not your coins. And listen, this isn't just some catchy slogan people throw around. It's a serious warning that was born from years of painful, real-world disasters where people learn this lesson in the absolute worst way possible.
This is one of the most important phrases, I think, in all of crypto and DeFi. Not your keys, not your coins. That simply means if you don't custody your own keys, then you don't own those assets, period, full stop.
And look, these are not just some made-up theoretical risks. This stuff has actually happened. Back in 2014, a huge exchange called MT was hacked. To this day, a decade later, some of those people are still fighting to get their money back. And more recently, I'm sure you remember this one, in 2022, the massive exchange FTX just collapsed. Poof. And customers lost billions of dollars that they were sure they owned. Okay, so if leaving your crypto on an exchange is basically just holding an IOU, what's the alternative? How do you actually get to that true ownership we've been talking about? The answer, my friends, is self-custody. This is the digital version of having cash in your pocket or gold bars in your own safe at home. You hold the assets directly because you and only you control your own private keys in your own crypto wallet.
Wow, this is so powerful. This is really the bedrock foundation of crypto and DeFi right here when it comes to self-custody is holding your own keys. It's like, the feeling that you get, honestly though, Myke, sometimes it can be scary because, right? Like you've got your keys and only you and only you are responsible for, keeping them safe. So that can be kind of scary sometimes. That level of responsibility can be. Where do you
Well, and
keep
especially if it's your whole life savings and, all your investments and, or you're retired, or you're living off it like you are. I mean,
exactly.
you would be, freaking devastated if somehow, you lost your keys or, somebody got a hold of them or, you did something to where it compromised your wallet. I mean, that would be a massive hit for you.
Oh yeah. Oh yeah. So I do my best to keep things safe.
Yeah.
But yeah, so it can be scary sometimes. I just wanted to, make that point that when you self-custody and you hold your own keys, just like Myke said, look, if something horrible were to go wrong, it's kind of like I'm SOL, shit out of luck a little bit. So that can be kind of scary sometimes, but it definitely is true freedom. Like true freedom comes from that level of responsibility.
Well,
Essentially,
most of the time, freedom comes with responsibility.
It sure does.
you become your own bank. Now, this kind of true ownership comes with some incredibly powerful features. You control the private keys. That means no one, not a company, not a government, nobody can stop you from sending or receiving your assets. It's what's called a bearer asset. Basically, whoever holds the keys owns the coins. Simple as that. But, and this is a huge but, it also comes with immense responsibility.
Right.
If you lose your keys, there's no 1-800 number to call. There's no customer support. The funds are just gone forever.
So if anyone ever calls you and says, yes, please, would you give me your keys? like
from
immediately,
Trezor or from Ledger or something like that. It's like they don't do that.
they don't do that. If anyone ever asks you for your keys, you immediately know that person is a scammer. So just keep that in mind.
Yes.
And all of this leads us to the final and maybe the most crucial part of this whole discussion, the fundamental trade-off that every single person in crypto has to think about. It's the trade-off between control and convenience. Just think for a second about everything a bank does for you, right? Storage, security, helping you get back into your account if you forget your password. Well, in self-custody, every single one of those responsibilities shifts to you. You store your own keys. You are responsible for securing them, and you are liable if they get lost or stolen. So what's the trade-off? What do you get in return? You get total, absolute, unconditional control. Look, this isn't about saying one way is better or worse. It's not about right or wrong. It's about you understanding what you're giving up and what you're getting in return. Do you want that full control and all the responsibility that comes with it? Or are you more comfortable trusting a big institution to handle all that tricky security stuff for you? So when does this true ownership thing really matter? Well, it shines in a few key situations. If you're someone who really distrusts institutions, if you need to know for sure that your transactions can't be blocked or censored, if you're storing a significant amount of value, or if you just really value your privacy, that's when self-custody becomes an absolute game changer.
But hey, on the other hand, let's be real. Using a custodial exchange makes a ton of sense for a lot of people. Maybe you're just starting out and learning the ropes. Maybe you're trading all the time and you need super fast access to your funds. Or maybe you just prefer letting a huge professional company manage the complex world of security for you. And that's totally okay.
So, Mike, what do you think about this? When convenience matters, what are your thoughts on using like a traditional exchange like Coinbase to custody some assets? What do you think about that?
I honestly, I think it's all part of onboarding. In adoption, it's there people are going to need that convenience. Most people are going to want that convenience of being able to direct deposit to a centralized exchange and potentially earn some yield on their stable coin, or just one click, and be able to be in a liquidity pool, or to borrow or lend. And the majority of people want that. I think the people like yourself and me, and others out there that are listening, that want a more that want more liberty, want more freedom, want more control over what's theirs, they're going to opt to self custody. They're going to opt to do these things manually, kind of the old school way, because the yields are higher. You might be able to earn 5, 6, 7% on USDC on Coinbase, but I know that David has strategies where he makes 15, 20% or more on that same stable coin.
Try
So
30.
yeah, no,
Yeah.
it's so it's all about that balance, finding the balance that's right for you between convenience and and having that what's the word I'm looking for? Liberty, freedom, but
America.
yeah, that too. But it's the term that's used in crypto a lot. Anyway, you know what I'm talking about.
Yeah, I sure do.
Yeah.
I think that there's definitely a place for these centralized exchanges. They almost function like on and off ramps
For
with,
people.
for people. Yeah.
Yeah.
And, they have all of these really cool products now. Like, Mike, I know you mentioned Coinbase has a credit card.
Yeah,
That's
I
really
use it.
cool. Yeah, man, I would get one for sure.
I've
I
made
think,
I've made like $400 just in the past month or two. Just because I get Bitcoin back for like 2, 3, 4% on every purchase. So I basically put all the bills that I was going to pay anyway. My propane, and my Starlink, and just groceries, gas, all that kind of stuff. I just use that instead, and I just pay it off in full at the end of the month, so I don't get charged interest, and there's no annual fee. So basically, for stuff I was buying anyway, I've made a couple $100 in free Bitcoin,
that's pretty cool, man. That is pretty cool. I think
but
Gemini
pay
has
it
a
off every fucking month.
right,
Don't let
right.
that roll over, because it negates the whole thing if you end up paying interest.
Yeah, but we're talking about convenience, and that's a convenient way to earn spot Bitcoin.
Mhm.
Just you spend using a credit card in the same way that you would otherwise, but when you earn cash back, it's paid to you in spot BTC. That is pretty cool.
Yeah.
So you see, the big takeaway here isn't that one choice is right and the other is wrong. Not at all. It's that you absolutely have to understand the huge difference between holding a promise from someone and having true possession of your own assets. Once you really get that, then you can make an informed choice that's right for you. So I'm going to leave you with this one question to really think about. Now that you understand the trade-offs between a promise and possession, between convenience and control, where are you going to choose to keep your assets?
I keep them on a steel plate. That's where I keep them.
I keep mine in my prison wallet.
That's right. So true ownership explained. So when you hold your own keys, as this little image shows here, you self-custody. You have custody of your own assets. That's true ownership. But when you keep your assets in a bank, they just give you an IOU, and that IOU can come with all sorts of strings attached. So yeah, just you got to know that. It's not that one is necessarily always better than the other. It's just that you need to know, you need to know this stuff, about your own money. So cash in your pocket versus money in a vault, kind of like that, that coat check idea that we were talking about a couple of weeks ago, where when you make a deposit at a bank, it's kind of like you give your coat to that coat check and you get the claim in return, that little piece of paper. But that coat, the bank is not going to just let it sit there because it's a liability for them. They're
Yeah.
going to take that coat and lend it out to someone else. So you're
Multiple
going to
times.
have multiple times. So,
Yeah.
if you give your coat to the coat check lady and all of a sudden she's renting it out to 5 different people, well,
You'd
she's
probably
going to
be
make
pretty
them.
upset about that.
I probably would too.
Yeah.
And then imagine you come back with your little claim ticket, and if enough people all come back at once with their claim tickets to get their coats back, well, the coats aren't there.
Well, and imagine you come back with your ticket and you give it to him and she's like, "Well, why do you want your coat back? What are you gonna do with your coat?"
Right. Exactly. And they
You're like,
would
"What
totally,
the hell?"
this looks like an expensive coat. Where are you taking this coat? That's like $2,000 coat. Oh man, yeah. So yeah, custody is the way to go, and not, don't surrender custody to a bank. At least that's my opinion. So let's see here. Custodial exchange trap. We've got 18 minutes left, and I want to get through lesson 3.
All right, let's
So
do it.
let's see here. Let's go through this last one here. The responsibility shift. So this is super important, right? When you use a custodial bank, they control your assets. And if they fail, then customer I should blah, 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 blah. That's the hallucination from AI there. But self-custodial, so when you custody your own your assets, you have access. Man, I'm getting messed up on that. It's safe, but you don't have the recovery options though. So you just gotta, compare custodial versus self-custodial. I'm gonna fix this little slide here. All right, let's move on over to lesson 3, permissionless finance.
Hey everyone, today we're going to tackle a pretty radical idea. What if our entire financial world could be rebuilt from the ground up based on just one single powerful concept? Let's dive in. So let's just start with this question right here. What if you never had to ask anyone for permission to open an account, to send money, or to get a loan? Just imagine a world with absolutely no financial gatekeepers. I mean, what would that even look like? To really get our heads around this, let's start with a simple analogy. It really makes it all click. I want you to picture 2 very, very different libraries. Okay, so on one side, you've got the gated library. This should probably feel pretty familiar. It's basically traditional banking. You need to fill out applications, you gotta have proof of address, and you need a librarian's approval just to get in the door. But then, on the other side, you've got the open bookshelf. No applications, no gatekeepers. You just walk right up and start reading any book you want. That feeling of freedom, that's the core idea we're talking about today. All right, so let's take that analogy and apply it to the real world of finance. It really all comes down to one thing: gates. Who's in charge of them, and what happens when they just disappear? And here's the key definition. Permissionless means exactly what it sounds like. You don't have to ask for approval. If you have an internet connection, you're in. That's it. There is literally no one standing at the door checking your ID or your credit score ready to turn you away. And this is where you can really see the difference in practice. Just look at the left side. All the hurdles of the traditional system, right? They're pretty obvious. But then look at the right. The process is just radically simplified. Instead of needing a credit score for a loan, you're interacting directly with the system's code. Every single gate that you see on the left, it just vanishes on the right. Now, getting rid of these gates has another huge consequence. It completely erases borders. You see, traditional finance was built for individual countries. This new system, well, it was built for the entire planet from day one. Just think about it for a second. Traditional finance is national by design. A bank in Tokyo and a bank in Lagos are playing by totally different rules, and connecting them is the slow, expensive nightmare of correspondent banks. But a permissionless system, it's global by default because the network is the same everywhere. The code works the exact same way in Tokyo as it does in Lagos. The rules are identical for everyone, everywhere, instantly.
So Lagos or Lagos, isn't that in Nigeria? Is that
It's a country in Africa.
yeah.
So
it's
why is being global by
hold on,
Sounds
hold
like
on.
Legos. Lagos? Is that?
It's
I
it's
think.
it's Lagos. It's actually, yeah, sorry, it's a city.
Yeah, it's a city. Isn't that in
It's in
Nigeria?
Nigeria, yeah.
Yeah.
default such a big deal? Well, it comes down to this number, 1.4 billion. That's how many adults around the world are unbanked. They are completely locked out of the traditional financial system. For them, a permissionless system isn't just a cool alternative, it's a potential lifeline, and it's accessible with just a basic smartphone. And
Right.
here's a perfect example, remittances.
I
That's the
know we
money
were
that
just
migrant
talking
workers
about
send home
this.
to their families.
Yeah,
Traditional channels skim off over 6% in fees on average.
that's
That adds up to
crazy.
billions of dollars every year that never actually make it home. A global permissionless system can slash that fee to under 1%. Just think about what that difference means for the families who rely on that money.
Hmm.
And this helps a massive range of people. We're talking migrant workers, international freelancers trying to get paid, small businesses that want to trade across borders, and of course, those 1.4 billion people who are completely left out of the banking system. But this level of openness isn't some simple utopia. It's really a double edged sword. We have to be totally honest about the very real trade offs that come with removing every single gate. The core idea here is simple. With no gates, there are also no guards. The very features that create all these incredible benefits, they also introduce entirely new kinds of risks.
Right. So this is where the self-custody, leads to self-responsibility. If you're walking out the gate and there's no one to save you, well, then you are in control now. And I think that's really cool. That real sovereignty. I think it's great, but it can be scary sometimes.
So, trade off
Absolutely.
number one,
Yeah, absolutely.
access. On one hand, it's great. No one can discriminate against you. But on the other hand, there's no one there to protect you either. There's no bank in the middle to verify that the person you're about to pay isn't a total scammer. Then there's this idea of finality. The upside is huge. No one can block or censor your transaction. But the downside? There is no undo button. If you send money to the wrong person or you fall for a scam, it's gone forever. That responsibility falls completely 100% on you.
So, Mike, one of my first operations in DeFi, when I was just taking a look at some of these tokens, back in like 2022, um, I didn't know what a honeypot scam was back then, and
Hey, big
I s-
boy, send me your seed phrase.
that's,
I
so that
promise. I'm a
that's
I'm a I'm
that's
a hot Swedish girl.
that's not what it was. So it was so this honeypot scam. The way that it worked was, I would see this amazing looking chart on one of the deck screener or whatever, and it looks like this token is just putting in a beautiful pattern just up and to the right. Looks great. And I thought, okay, well, I want to try this out. I'm going to try it out with $10, right? I'm going to start really, really small. So I swap into this token and I realized I couldn't exit. I was stuck. I could not exit the token.
Yeah.
And so when I started reading about the honeypot scam, basically all it is they change code in the token
Mhm.
after funds are deposited, so that either there's like a 99% exit tax or you can't exit at all. It's a 100% exit tax.
Yeah.
And so, yeah, these, all of these different types of scams, when you send money in crypto and DeFi, if you are not 100% sure where you're sending, then, there's a pretty high likelihood that it'll just be gone forever. So you got to make sure that you know who you're sending to, where you're sending, on what chain you're sending the right asset. You've really got to make double, triple, make 100% certain that you're operating properly.
Mhm.
Um, so yeah,
And finally, inclusivity. The benefit is massive. It's a powerful tool for the unbanked and for people living in unstable economies. But the risk? Everyone truly means everyone. And that includes the bad actors. A system that's open for a freelancer in Indonesia is, by definition, also open for a global scammer. And this quote just hits the nail on the head. We can't think of these risks as bugs that just need to be fixed. They are fundamental, inherent trade offs. The very same feature that creates the good, the openness, is the exact same feature that allows for the bad. So, given these trade offs, who is this technology actually for? I mean, who benefits the most from a system that has these very specific pros and cons?
Well, I think that anyone who is willing to learn this stuff, and I think anyone who wants to build on top of it. So, I've been working quite a bit on building a couple of different protocols. And so, what I see as one of the biggest benefits of crypto and DeFi is that it democratizes access to financial products. And what that means, I think, in practice is anyone with the skill set can now build any type of financial product that they can imagine. And, with all of these AI coding tools now, you don't even need to be a professional software engineer to build this stuff. So, who benefits most? Is it, the people in Indonesia or in Africa or in Southeast Asia, people who are unbanked and don't have access to traditional bank accounts? Are they the ones who benefit most from crypto and DeFi and self-custody? Or is it, the financial engineer who wants to build new products to serve those people, or build new products just to serve anyone, really? Who benefits most? I'm not quite sure. I think that we both do. The people who need access to financial products, they benefit quite a bit. And also the people who want to build those financial products benefit quite a bit. So,
Well, I know, like, for example, on Canton, they actually incentivize people to build and, things like that. There's a lot of chains, and it's a very centralized chain, full transparency. I mean, last night, you and Colin were talking about it. And, of course, I've talked about it a lot on the channel and to it. It's so I won't go down that road, but yeah, basically it's important to understand, the value proposition, who benefits, from that chain, who benefits from, however that, the mechanisms or the functionality of it, who benefits from the token, either holding it or, minting it or earning it, just what are the details of it. And because that is going to give you a very good understanding if it is just a good technology or if it's beneficial to actually invest in, buy the token.
yeah, when it comes to tokens or coins, we've really got to start learning about incentive systems. And so we're going to get into that, but probably not today. So,
Yeah.
Crucially, the value here is not the same for everyone, not even close. If you already have a great bank account and you live with a stable currency, the benefits, they might not seem all that compelling. But for some,
so doesn't Michael Saylor say something like, you'll get to Bitcoin when you need to, or like there's the need to know? I think he talks about that quite a bit. Oh, my headset
It's
died.
not exactly that, but I know what you're talking about. He does have like a phrase like that. Like people buy Bitcoin when they need Bitcoin. It's something. Yeah, it's something. I know what you're talking about, though.
Yeah, so if you have access to traditional finance products, right, and you don't have a need to, get into crypto and DeFi, then maybe you won't quickly learn about it. But it could also be that people need to get into crypto and DeFi. They just don't know they need that yet. Because, I mean, if you're stuck in the matrix of traditional finance, then maybe you just don't know that
Well,
you need.
in business, they have something called a pain point, and I use this term a lot. It's really the purpose behind pretty much anything that you buy is, they and the more painful the pain point is, then the more profitable it will be. So, like Windows, the pain point was you had to be a programmer to use a computer. You had to know how to type, program code and tell the computer, I want you to do this, I want you to go there. And they came up with a product that you double click on a little, cool little picture, and it does all that for you. Vacuums. Didn't want to
Vacuums.
sleep. Yeah, that vacuum.
Vacuums are good. I like vacuums. That
Yeah,
guy
no,
Dyson, he builds one hell of a vacuum, man.
well, but there's just, that's basically what they're talking about. people adopting crypto, it's when they realize the pain points it solves, that is what's going to onboard people. The a more intuitive UI or user interface, you know
Right.
more making it more it more streamlined to onboard people, using things like Coinbase and things like that. That natural progression, those baby steps where you work people into a technology. I live in an area where there's a lot of really old people. I still see old people with a checkbook at the cash register at the grocery store. They haven't
No,
adopted technology. And
it's
you're always going to have those people, but that used to be everybody. I mean, I remember before cell phones. I remember before pagers, you
back in
know.
my day.
Yeah, back in the 1900s,
Yeah.
when I went to went to town for some rock candy and a bolt of cloth, and it's it there is an adoption curve when it comes to new technologies, and we're at the very beginning of the crypto adoption curve. So,
I think so. I really do. I really do. And this sell-off in crypto that we've seen over the last couple of days, this is going to turn out to be such a gift because this technology is not going away. Bitcoin, Ethereum, Solana, all the rest of them, this stuff is not going anywhere. It's just going to grow. And so being able to get access to these networks and pay less in US dollar terms to get access now, I think it's going to be a phenomenal opportunity. So, I guess it depends on your need. If you don't have the need, then you might not learn about crypto and DeFi. But I think it also comes down to the ease of onboarding people. Like if you've got the grandma at the grocery store writing a check for groceries, if she was able to onboard and it was intuitive to her, then I guarantee you she would no longer use that checkbook. If it was super easy to understand and you just got it and you didn't have to even like learn anything new, it was just like, oh, yeah, that makes perfect sense. You know how when you open up an Apple product, like you're supposed to be able to set it up without having to read any type of manual? It's supposed to be intuitive. Well, as soon as crypto and DeFi is able to make the onboarding of new users as intuitive as opening up an iPhone and turning it on and using it within 5 seconds, as soon as that is the case, we'll see the floodgates open and you'll have billions of people flood on chain. So I think that we're close. I think that we're close, just not quite there yet. It's still kind of on a need to know basis.
One in a different situation, the entire calculation is completely different. The impact is absolutely highest for those who have been let down by the traditional system. We're talking about people who can't get a bank account, citizens who are facing capital controls from their own government, or anyone who's watching their life savings evaporate as their currency collapses in real time. For them, the benefits of an open system can easily outweigh the risks. Okay, so let's tie this all together really quick. At its core, permissionless means a global system with no gatekeepers open to anyone with an internet connection. But you have to remember that central trade-off. No gates also means no guards. And because of that, the value of this system isn't the same for everybody. It's most powerful for those who have been left behind by the world we live in today. Which leaves us with the final big question to think about. When you weigh the incredible potential for financial inclusion against the inherent risks of total openness, is building a financial system that's truly for everyone a risk worth taking? That right
Yes,
there is the debate at the very heart of this technology.
it is. It is a risk worth taking. I think it is 100%. All righty, Mike. So we've run out of time,
Yep.
and a good call starts and ends on time, I think. So let's see here. Tomorrow, we're going to continue with the crypto fundamentals course. We were able to get through lessons 1 through 3 today. Tomorrow, we'll go through probably 4, 5, and 6. And I'm looking forward to it, man.
Absolutely. And just so everybody knows, I mean, since we're doing this show, I know that Jake said that he wasn't going to be able to make the DeFi masterclass later. I mean, are you still wanting to do that, or are we just wanting to just pick it up next week?
Um, I guess we could do it if you want to.
We'll chat about it offline.
Sure, man. All righty. Well,
awesome.
we'll talk
Oh,
later.
thank you all for tuning in. And until next time.
Thanks,
Metro
everyone.
Crypto out.
Peace.